All right, let's talk about Clean Harbors. You might know them as North America's biggest hazardous waste disposal company, basically the continent's cleanup crew. But here's the question for us as investors. Is this just a garbage business? Or is it actually a high-tech environmental services powerhouse with a seriously impressive competitive advantage? Let's dig in and find out. Okay, first things first. To understand any company, you've got to follow the money. And this chart, it tells a really clear story. The business is overwhelmingly dominated by its environmental services segment. I mean, look at that, $5 billion. The other piece of the pie, Safety-Kleen, is nothing to sneeze at, pulling in almost $1 billion itself. But the real engine, the heart of this company, is absolutely environmental services. And this two-part structure, well, it's the key to understanding everything else we're going to talk about.
So you've got this tale of two segments, right? On one side, you have environmental services. Think of this as the reliable, high-margin workhorse. It's driven by regulations that companies have to follow, so it's super steady. Then you've got Safety-Kleen. This part of the business is a little more wild. It's tied to things like the price of oil, so it can be cyclical. But here's the really clever part. Safety-Kleen isn't just a side business. It's a massive lead generation machine. It gets Clean Harbors in the door with thousands of customers who they can then upsell to their much more profitable environmental services. It's a pretty brilliant setup.
Okay, here's how we're going to break this all down. First, we'll look at the company's incredible competitive moat. Then we'll check out the future growth engines, what could go wrong with headwinds and hazards, and finally, we'll get to the big one. Is the price right?
All right, Section 1, the unbreachable moat. So why is this business so durable? Let's get into the core of the investment thesis here. What really protects this company from competition?
Now, you hear this term competitive moat thrown around a lot. So what is it, really? Well, think of a castle. The moat is what protects it from invaders. In business, it's the structural advantages that protect a company from its competitors. And let me tell you, Clean Harbors has one of the widest, deepest moats you're likely to find.
So their moat really rests on three massive pillars. First, the barriers to entry are just unbelievably high. We'll get into that. Second, their customers are incredibly sticky. It's a huge pain for them to switch providers. And third, they have a giant network that gives them huge economies of scale.
You know, high barriers to entry can sound kind of abstract. So let's make it concrete. Take a look at this number, $210 million. That's what it cost them to build their new incinerator in Nebraska. And get this, it took 4 years just to get it permitted and built. Why? Because nobody wants a hazardous waste incinerator in their backyard. So you have to ask yourself, who on earth has the deep pockets, the patience, and the technical know-how to even try to build one of these things? The answer is almost nobody. That's a barrier. And that brings us to the second pillar. Once Clean Harbors gets a customer, they tend to stick around. And why wouldn't they? Think about it. If you're a company generating hazardous waste and you mess up how you dispose of it, we're talking about crippling fines, endless lawsuits, and a PR nightmare. So are you going to risk all of that just to save a few bucks with some new, unproven provider? No way. You stick with the trusted, reliable name. It's just not worth the risk to switch.
Okay, so we've established the business is basically a fortress. It's stable, it's durable, it's protected. That's fantastic. But as an investor, we also want to see growth, right? So where is that going to come from? Well, this is where the story for me gets really, really interesting. So there are really three key growth catalysts to watch here. First, that brand new $200 million incinerator we just talked about. It's just now starting to ramp up and absorb all this pent-up demand. Second, and this is a big one, you have the massive emerging market for cleaning up PFAS, the so-called forever chemicals. And third, Clean Harbors is constantly and very strategically buying up smaller players in the market, what we call a roll-up strategy.
Let's just zero in on this PFAS thing for a moment because it's a huge deal. These forever chemicals are literally everywhere and they don't break down. It is a massive, multi-decade environmental problem. And as the government cracks down with new regulations, a brand new, multi-billion-dollar market is literally being created out of thin air for the few companies that have the technology to safely destroy these things.
And here's the kicker. This is the proof point. Clean Harbors didn't just go out and say, hey, we can destroy PFAS. Nope, they worked with the U.S. Environmental Protection Agency to prove it. And their incinerators achieved, get this, 99.9999% destruction efficiency. That's not them grading their own homework. That's the EPA validating their tech. In a business built on trust and compliance, that kind of third-party validation is an absolute game changer.
And this all comes back to their dominant position in the market. I mean, just look at this chart. Clean Harbors controls 60% of all the commercial hazardous waste incineration capacity in North America. 60%! When you have that kind of market share in the most critical, high-tech end of the business, you get what's called pricing power. It means when a massive new problem like PFAS comes along, you're the one everyone has to call. Okay, it's not all sunshine and roses. Of course not. No investment is risk-free. So to be fair, we have to look at the other side of the coin. What are the headwinds and hazards? What could actually go wrong here?
It's really a story of two competing forces. You have these huge, long-term trends, what we call secular tailwinds, that are all blowing in their favor. Think tighter environmental rules, companies focusing on ESG, and more manufacturing coming back to North America. That's all great for them. But at the same time, they have to deal with short-term cyclical headwinds. Things like a bad recession that slows down industrial activity, or wild swings in oil prices that hit their Safety-Kleen business.
So if you're an investor, what do you need to keep your eye on? Well, it really boils down to a few key things. First and foremost is execution. It's one thing to have these huge opportunities like Kimball and PFAS. It's another to actually deliver on them. Then there's acquisition integration. They just bought a big company called HEPACO. Can they make that work smoothly? And of course, you can never forget the inherent risks of this business, the potential for an environmental accident or just rising costs eating into their profits.
And that all leads us here to the final and maybe most important question for any investor. We've laid out the case. This is a fantastic company with a deep, deep moat and some really exciting growth drivers. But what about the price? Is the stock a good buy today?
So let's put Clean Harbors up against its big peers, companies like Waste Management and Republic Services. What you see is pretty fascinating. If you look at one common valuation metric, the PE ratio, they all look pretty much the same, trading in a very tight range. But, and this is a big but, if you look at a different metric, EV to EBITDA, which a lot of people prefer for capital-intensive businesses, a different story emerges. Clean Harbors trades at a pretty significant discount to the others. So, why should you care about that? Well, that EV to EBITDA metric is arguably more relevant here because it strips out non-cash charges like depreciation, which are huge in this industry. So that discount is real, and it tells us something. It suggests the market is maybe looking at that more volatile Safety-Kleen business and penalizing the whole company for it. Or, and this is the exciting possibility, maybe the market just isn't fully appreciating the massive long-term growth potential from something like PFAS. And that right there is the entire investment debate in a nutshell. The stock is not cheap. The market already has some pretty high expectations baked into the price. The bull case, the reason you'd buy the stock today is that you believe the true scale of these growth opportunities, especially PFAS, is still being massively underestimated. The bear case is that, hey, maybe it's all already priced in. So the central question you have to ask yourself is this: can the company's significant growth opportunities allow it to blow past the already optimistic expectations that are embedded in its valuation? The answer really comes down to execution. Can they turn all this incredible potential into reality?